So you're thinking about buying a home? It's a huge step, probably one of the biggest financial moves you'll ever make. But let's be honest, the language that comes with it, all the jargon, can feel like a complete mystery. Well, that's what we're here for. We're going to pull back the curtain on the world of mortgages so you can walk into the process with confidence, knowing exactly what you're getting into.
Ever felt like you need a secret decoder ring just to figure out what lenders are talking about? Yeah, you are definitely not alone. It's designed to be confusing, but don't worry, by the end of this, you'll be speaking their language fluently.
So, we've mapped this whole thing out for you as a 5-part journey. First, we'll cover the essentials at the starting line. Then, we'll decode your loan offer so you can read it like a pro. After that, we'll help you choose the right mortgage type, understand the long-term price of the payout, and finally, get you across the finish line. All right, let's dive right in. Before you even think about making an offer on a house, there are a few key ideas you absolutely need to get your head around. Nailing these down from the start shows everyone you're a serious buyer.
First thing you'll probably hear about is an agreement in principle, or AIP. Sometimes it's called a decision in principle, or DIP. You can think of this as your golden ticket. It's that crucial first step where a lender takes a look at your finances and gives you a preliminary thumbs up, telling sellers you're good for the money. But, and this is really important, it is not a guaranteed mortgage offer just yet.
Okay, next up, loan to value, LTV. This little number is one of the most powerful in the entire process. It's just a simple percentage that shows the lender how much skin you have in the game, your deposit, versus how much of their money is on the line.
And hey, the math is actually pretty simple. You just divide how much you're borrowing by what the house is worth. So like you see here, if you borrow $200,000 for a $250,000 home, your LTV is 80%. That other 20%, that's your deposit, your stake in the game.
So what's the bottom line here? It's simple. The lower your LTV, meaning the bigger your deposit, the less risky you look to the bank. And what's your reward for being less of a risk? A better, lower, cheaper interest rate. This is without a doubt one of the biggest ways to save thousands, even tens of thousands of dollars over the life of your loan.
And all of this leads to the ultimate goal, equity. Think of it as your slice of the pie. It's the part of the house that you and only you actually own. Every single mortgage payment you make builds your equity, and if the home's value goes up, your equity grows even faster. This is what homeownership is all about. All right, you've got the basics down. Now for the fun part. Kidding, it's paperwork. But this is where it gets real. You've got an official offer, and now we need to decode all that fine print so you know exactly what you're signing. So after you apply, the clock starts ticking. Lenders have just 3 business days to send you something called a loan estimate, or LE. This is a standardized form, and its whole reason for existing is to make your life easier. It breaks down all the key costs and lets you compare offers from different lenders on a true apples-to-apples basis. Now, listen up, because this might be the most important tip I can give you. Don't get hypnotized by the advertised interest rate. The number you really need to care about is the APR, the annual percentage rate. Why? Because the APR is the true cost of borrowing. It takes the interest rate and bundles in all the other lender fees and charges. It will pretty much always be higher than the interest rate, and it is the only number you should use to compare loan offers fairly. Now, when you look at your monthly payment, you'll see this little acronym everywhere, PITI. It stands for the 4 things you're actually paying for. You've got P, principal, the money you're paying back, I, interest, which is the bank's fee, and then taxes and insurance for the property itself. So what about that T and I, the taxes and insurance? Well, that's where something called an escrow account comes in. It's basically like a piggy bank your lender manages for you. They take a slice of your monthly payment, put it in this special account, and then when those big property tax and insurance bills come due each year, they pay them for you. It's a way to make sure there are no nasty surprises. Okay, section 3. Now that you can actually read the loan offer, what kind of mortgage should you get? They are not all the same, and the best one for you really comes down to your own financial situation and, honestly, how much risk you're willing to take. You're mainly going to see 2 big options on the table, fixed rate and adjustable rate mortgages, which everyone just calls ARMs. A fixed rate loan is all about predictability. Your payment is the same on day 1 as it is on day 3,000. An ARM, on the other hand, usually tempts you with a lower initial rate, but that rate can go up or down later on, which means your payment can change. It's a choice between stability and a bit of a gamble. But wait, there's more.
Beyond those two, you might qualify for some special government-backed loans. FHA loans are great for buyers who might have a lower credit score. VA loans are a fantastic benefit for service members, often with no down payment required at all. And USDA loans are out there to help people buy homes in certain rural or suburban areas. All right, time to pull the camera back and look at the big picture. We're talking about the entire 30-year life of your loan. This is where you see how much it really costs to borrow hundreds of thousands of dollars.
There's actually a complete roadmap for your entire loan, and it's called an amortization schedule. Think of it as a giant spreadsheet that details every single payment you'll ever make. It shows you, down to the penny, how much of your hard-earned money is going to the bank as interest and how much is actually paying down your debt.
Okay, now check this out because it's kind of shocking. That very first payment you make, a massive $600 goes straight to interest. Only about $130 actually pays down your loan. But then, fast forward years and years to payment number 257, look at that. The whole thing has flipped. Now, most of your payment is finally building your own wealth.
And that right there is what we call the tipping point. For the first decade, maybe more, you're mostly just paying the bank for the privilege of borrowing their money. It's only deep into the loan that your payments really start to make a dent. And that's exactly why making even small extra payments towards your principal early on can save you tens of thousands of dollars and shave years off your mortgage.
Okay, deep breath. We've made it. We are at the finish line. Section 5, closing the deal. This is where all the paperwork comes together, you sign your name 100 times, and you finally get the keys. But first, there's one last hurdle.
You have to be ready for something called closing costs. And they are not cheap. These are all the fees for all the services that make the deal happen, and you can expect to pay somewhere between 2 and 5% of the home's purchase price. So on a $300,000 home, you better have up to $15,000 ready to go, in cash.
So you might be wondering, where the heck does all that money go? Well, it's a mix of things. You've got lender fees, appraisal fees, title insurance to make sure the home is really yours, government taxes, a whole bunch of stuff. You'll also have to prepay for some things like your first year of homeowner's insurance.
And for the grand finale, the closing disclosure, or CD. By law, you have to get this document at least 3 business days before you sign anything. This is it, your final look at the numbers. Your job is to take this document and compare it, line by line, with that original loan estimate you got weeks ago. Make sure nothing looks fishy. And once you do that, you're ready. You're no longer just a home buyer, you're an informed homeowner. You did it. Now go get those keys.